This will be different than any other panel that you've participated. It's where bank and fintech come together. And I want you to just notice, if you look at the panel, you'll be able to tell which role each of the individual is playing by their shoes. And so on the very far end is like most traditional bank. We got Alan down there, right? And then if you just kind of make your way this way to the sneakers, I'm representing the fintech side of the panel, right? And then kind of the mix in between, right? Fair. So I'm very excited about the conversation today. We're going to talk all about kind of how fintech and banking work together in innovative ways. My name is Brock Blake. I'm the co-founder and CEO of LendIt. LendIt, a lot of people know us, especially small business owners, as the largest marketplace in the U.S. for business loans. So business owners come to us to shop for working capital loans or lines of credit or term loans or SBA loans. We're also a platform for lenders to acquire customers and automate their loans, and a platform for partners that have small business owners. We embed our marketplace into their platform to help their small businesses get access to capital. We are joined with a rock star panel and of both banks and CDFIs that are innovating within small business lending. And so I'm going to just take a minute. We're going to start with Francisco, then Joe, Matt, and Alan. Have each of you just quickly introduce yourself and your institution.
Thank you, Francisco Lopez. I'm with DreamSpring. We're a 28-year-old CDFI based out of Albuquerque, New Mexico, and I'm the CEO at the organization.
Good afternoon. My name is Joe Quiroga. I'm president at Texas National Bank. We're a traditional community bank headquartered in the Rio Grande Valley, which is right on the U.S.-Mexico border. We're a Hispanic-owned minority deposit institution and also a CDFI.
Matt Nicolosi, Senior Vice President of Head of Strategy and Innovation for Bay First National Bank, and we're located in St. Petersburg, right outside of Tampa, Florida.
My name is Alan Toms. We, with Cadence Bank, we're a 140-year-old, $50 billion community bank based out of Houston and Tupelo. I'm the EVP and Managing Director of SBA Banking.
And we want to congratulate both Joe and Francisco. Both Texas National and DreamSpring were recipients of, what is it called, the CDFI Equitable Recovery Program. They got a bunch of funds to deploy to underserved small businesses, and the Vice President Kamala Harris announced it on April 10th. That's a big deal. To qualify for that is awesome, so congratulations.
Thank you.
So today we're talking fintech partnerships, and I'm going to start on the end over there with Alan. It says, Ernst & Young reported that 95% of banks use or expect to use fintech partnerships to enhance digital products and reach. What are you guys doing? It's a 140-year-old bank, right? What's your viewpoint on working with fintechs, and what are you doing?
Two positions there. One, it's a necessity, right? As a 140-year-old bank, we have legacy platform systems that have been around longer than they should. And so it is hard to turn a Titanic when you're that old and the size that we are. So the partnerships, like the ones we have, are a big part of the solution, because I can leverage those relationships, the innovation, the things that you guys are able to do much more nimbly without me having to talk about a core conversion of a $50 billion bank and so forth. So it's a partnership that I think is working very well, and I think for a lot of us is going to be the strategy or required strategy for a period of time.
So Matt, you're a fintech turned banker, right?
Sure am.
Is that fair?
That's very fair.
I know that one of the challenges from a financial institution, from a banking institution, is like you've established credit policy, underwriting standards. I know banks talk about, everyone wants to do AI or this black box. Maybe talk to us about the importance or how you think about working with a fintech and like using your own policy and credit standards versus adopting, maybe what someone's coming to pitch you.
No, of course, and Bay First being a $1 billion bank, right, versus Alan's $50 billion, still similar challenges, right? But as Alan mentioned, we definitely see fintechs as an ally and almost a necessity for growth and the future. The nimbleness, the creativity, the customer experience, and customer acquisition channels are vast and very just key to a lot of fintechs out there, and very specifically to LendIt, and they do an amazing job at that. On our side of the fence, we do need to control credit. We do need to have customer experience, know your customer, and sort of abide by all of our policies and procedures, and remain in compliance and in good standing with our regulators. And they're our biggest partners, if I would say so first, right? So it's immensely important for the success of us. But we love to figure out what we do best, which is that compliance piece and banking, and allow the partnership with great folks like LendIt to handle their side, which is that customer acquisition, technology, and data. And right now, we really specifically look for partners that are data first and data specific, because the cleaner that is, the faster we can move and improve the customer experience along the way.
Let's hear from both of you. Yeah.
Brock, if I could just add that, in the 15 years that I've been in banking at my particular bank, we went from about 8,200 banks in America to 3,800, I think we're at right now. And, there's been a lot of opportunities that we've lost as an industry. And so I guess I can be critical of the industry when I'm in the industry. We haven't been doing a good job of innovating. And so I think this is our opportunity. And really, I think we've sort of woken up to say, we need these relationships. If you can't beat them, let's join them so that we can create some good opportunities.
So what are you doing? Like, how do you think about, what are some of the things, talk about how you've worked with partners?
Well, we've had to revisit, what is that we've lost along the way. We've lost auto lending, we lost consumer lending, we lost, a lot of these platforms that we used to own as an industry, and we've completely lost them to whether it's credit unions or fintechs. And so small business banking and commercial banking for us is the last frontier. We absolutely can't lose that. That's what keeps me up at night. So we've got to get better at the onboarding. We got to get better at workflows. We got to get better at the automation piece. And we just historically have not done a good job of that. And so we're partnering up with different folks, LendIt being one of them, to say, let's educate ourselves first and foremost. And number two, let's give the consumer and the commercial client what they need and what they want, which is nimbleness.
All right, Francisco, you're up.
Well, since we're talking about the different sizes of the organization, we are a nonprofit CDFI. We have $100 million in assets, which is very different, but we face the same challenges. So the organization has been doing small business lending to underserved target markets for 28 years. But 6 years ago, the organization acquired its own technology, started to develop it, to continue to look for a path to scale. And the only way that we can scale is through partnerships on the fintech side, on the technology side, that enhances the technology that we already have and that we continue to work on. But we also partner in the markets that we serve, like our partnerships with LendIt and other associations that serve the same target markets that we do. We believe that the only way that we can scale our impact is through partnerships with fintechs that do a lot of what we want to do much better and quicker.
So all of you are here because you believe in that. You believe there's opportunity to have traditional banks work with you've talked about innovation, speed with fintechs. Let's go off script for a second and talk about what's the downside. What are the things that keep you up at night when you're going to partner with someone? What are the things your regulators are asking you about? What are the things that your credit officers or other things that are like, okay, but let's make sure we validate A, B, and C. Like, will you give us a glimpse into the other side of that equation? Any of you?
I certainly have a view there. Coming from a more traditional bank, from a long career in banking, this is a marathon, not a sprint. And I think a lot of fintechs, their world is in months and a few years, and it's origination. And okay, we've gotten very good at originating loans. Now I've got to collect those loans, and then at some point I've got to liquidate those loans. And that's a life cycle that's 5, 10, 15, and with SBA's case, that's 25 years in some instances. So I think we have done a very good job at the origination. And I think the next step, and the part that makes me a little nervous, is proving the case as these things mature and as we go through these. How can you help us collect them better? How can we liquidate them? How do we get out of the ones that were the bad decision? We're not perfect, right? One of these loans we made is going to go bad. And so how do we do that? And so that's kind of where because the regulators, their insurance, they're making sure we don't fail. And so that's their first question. So I have to prove to them that we've understood and looked at that and have that under control. And so I think that's where we're still, it's sort of infancy, if you will, of educating the regulators, understanding where that is and what that's going to look like.
Yeah, I'd echo a lot of what Alan just mentioned. I think to a few of your points. One, when a loan does go bad, we're on the hook for that. We're on the hook for it, obviously financially, but in the eyes of our regulators, the SBA and our two banks, they want answers. So we're the only ones that can answer that question when they do come knock on the door. And towards you mentioned days and weeks and months, we do operate a little bit more slowly, but everything's got to be a lot more documented than I think a lot of people realize. Because if you are moving too quickly, your regulator is going to ask, why are you moving so quickly? So it's definitely the nature of the beast. But I think getting your biggest partner, your regulator, on board with proper documentation, answers to their questions in a timely manner, we've had great relationships and we've seen no problems. But I think that's probably one of the biggest mismatches, Brock, is why can't we turn this on now? Well, we need to explain a lot internally, board, regulators, auditors. Everyone's going to have questions, and we need to have good, solid solutions for all of them.
So in our case, I come from the fintech space, so there's no need to convince me about the value. I think what keeps us up at night are a couple of things. One is we would like to do things even quicker and faster, have the resources to integrate and iterate and learn and grow even quicker than we currently are doing. So that's a resource issue. The other piece is the client journey and the actual relationship with our borrowers. So we've been built on a foundation of having a high-touch relationship with our borrowers as a CDFI, which impacts the repayment rate, impacts the life of the small business or the entrepreneur. So when we partner with third parties and we grow digitally, that I think is our biggest challenge. How do we maintain that same level of relationship with borrowers for them to be successful and us to be successful? And doing it through partnerships and through fintech, that is difficult, no? Then on the front end, everything that has to do, especially when you're doing everything digitally, and it's been talked about in this conference, like everywhere, is just fraud prevention, no? I have an old saying that says, if you're washing plates, you're breaking plates, right? So if you put yourself out there, you're going to get fraud attempts. And that keeps us up at night, and we work with fintechs to try to mitigate that risk as much as possible.
I would just say, obviously there's two different cultures, right? There's the banking culture has been very, set on its ways. Let's Eddie steady, don't change if it isn't broke. I mean, that's just kind of the way we were all brought up. We're conservative by nature. And so I think everybody up here, we have this longing for, being a little bit different, for being a little more agile. And so it's not, like you were saying, Matt was saying, we got to go convince our board. You got to go convince your regulators. We just finished up our, exam with OCC, and we had about 10 or 12 different products that we had introduced since the last time they were in the shop. And so we were telling them 8 months before, we have 10 different products, we're going to tell you about them. And we went up to visit them. I mean, it was an event just to get them to the exam when we finally saw the 10 different products and understood we still had a lot of risk mitigation, in those 10 products, but it's kind of frowned upon, right? And so we want to be agile, that's why we're all here, but sometimes there's a little bit of pushback from the regulatory bodies.
Maybe I'm going to pick on you a minute just because I'm very aware of this. You have Ray, who's a former regulator, right? You've hired him at the bank and put him in this unique position of, let's put a former regulator in kind of this innovative position. Maybe can you talk about that for a second, your approach?
Of course, we all have great team members, but Ray in particular is a great team member for us. And he'd been at the OCC accredited regulator, examiner, I should say, for 13 years. And so he led teams, and he was doing very, very well at the OCC. And I had my eye on him for about 5 years and said, this guy has too much of a personality to be a regulator. I need to bring him on to the bank, truly.
No offense to any regulators in the room.
Yeah, sorry. And I kept telling him that, and I said, hey, you really belong on this side. And so we finally kind of, he had had a baby and he wanted to move down, and we kept in touch, and I said, let's talk about you joining the bank. And so we sat down, and he initially gravitated to, I said, what do you want to do at the bank? And he said, well, I want to be a chief risk officer. And I said, you don't want to be a chief risk officer. I said, you know that. That's easy for you. Let's come and do something a little bit more innovative. Let's look at some strategies for the bank. And so he's our chief strategy officer at the bank today. And I put him in this really uncomfortable spot on purpose because I kind of saw something in him and that he didn't even see in himself. But it really allowed us to be, now his idea is not how do I prevent it from getting done, but how do I do it within the framework of what the regulations call for.
He's doing a great job. Okay, we're gonna focus on BayFirst and Cadence for a second. So, what I love about BayFirst and Cadence is that in the SBA world, it's tough to innovate and to be efficient and fast with SBA lending. There's a lot of hoops you have to jump through, a lot of I's you have to dot and T's you have to cross, and all the things. But BayFirst and Cadence are two of the most innovative and kind of efficient lenders out there for SBA lending, even among non-bank lenders and everything else. So maybe just talk to us how you think about SBA lending, your process, what tools you put in place to be able to speed that up, and some of the success you've had.
So for us, I looked at SBA as, you have banking regulations and all of your core regulators, and then on top of that, you throw the Small Business Administration, who publishes a massive SOP document, expects you to live by it, and when you ask them a question, they say, well, it says this. It's like, I know what it says, I want to know what it means, and they won't answer it. So then it's this armchair quarterback, and I said, okay, how do you take a complex process with lots of regulation and simplify it down to the basic elements so that the client experience is as best as you could hope it can be? And that is through partnerships like this with LendIt and others that I say, okay, they're making that client experience better so the client doesn't feel like, oh, here's your stack of 50 SBA documents. When you get them finished, come see me and we'll talk about it. The client's kind of spoon-fed the regulation. The intelligence in the systems will weed out the things, and it allows us to have that client have a better experience, and then I end up with a more consistent product. And the consistency is what I need to show my regulators that, hey, not only are we doing this volume and we're stepping out, but we're doing it in a consistent, formulaic manner that's predictable, and that they can come in and look at, and when these loans do go bad, actually our performance on those loans has been exceptional when it comes to the liquidation side because of that. Because it's very formulaic, but it's done in a way that the client experience is still good. Because when I first started in SBA, you had the old school SBA banker, and he literally would say, here are the forms you need to fill out and see me in a week. Well, that's a terrible client experience. And so how do you bring that current? I think we still have a long ways to go, honestly. I think the SBA and the releases they just did this week are trying, but I think they're trying to figure out their identity in this as well. So that's my 2 cents. Yeah.
No, it's very fair. I think we've, BayFirst, again, billion-dollar bank, so smaller bank than most. And SBA is our bread and butter. We really, it's our biggest revenue driver. But we grew up on partnerships as a bank. And it's great to be in the same league as a Cadence and to be on the same stage as Alan. He's an SBA juggernaut. And I think for us, we looked at it and try to continue to innovate. And we've come out with some unique, products and unique partnerships. And it's kind of built us into becoming a top 5 SBA lender in the nation. And for being a billion-dollar bank and having to compete with JP Morgan Chase and Bank of America and Wells with hundreds and thousands of branches and people, you got to think differently. And partnerships is a big way that we have done that. And you kind of sit back and you go, what have you mastered? And Brock kind of mentioned, I came back from a full circle of commercial banking, fintech, now back at a community bank, and help build out a fintech and go, what do we know and what are we great at? And it's customer experience, it's customer touch, it's boiling down that 300-page SOP document, which is boring as all hell, into something that you can digest, teach others, and have an amazing customer experience, and create and put something together for a bank that can look at it and productize it. For us, being able to bucket these loans and sell them off and have that ability to do so is a huge revenue driver for us, and it's something that we've been dependent on and lean on. But we just see continued growth through different ways of looking at how to do SBA loans, because there's still that stigma in the market, right? Yeah. It's going to take me 6 months to close an SBA loan. There's no way I want to go near that. Well, that's not the case. Right. You know, if you work with the right partners that have that expertise, and you work with fintechs that know it inside and out too, you can get done in 5 days. I mean, that's the reality. So there's a lot of misnomers.
That's not just like a one-off. That's what I love about these. It's not like, oh, just one deal out of the last 1,000 we did was 5 days. This is consistent kind of process and structured innovation around SBA lending that normally you go do an SBA loan and it's minimum of 6 weeks and just pain, you know. But I love the way you guys are innovating in this product space category. All right, so Joe and Francisco, so these two CDFIs and Texas National as a bank really has focused on the underserved community. Small business owners that maybe were overlooked, or you know, women-owned businesses where the owner's a person of color, or Hispanic-owned businesses, or other things like that. And you've had to think about it differently than maybe traditional underwriting and traditional lending. Specifically, a lot of the bank transaction data that you're leveraging to look at kind of the cash flow of the loan. We'll start with you, Joe. Can you talk to us about how you're thinking about underwriting and serving that underserved small business owner?
Well, we have a culture issue with the Hispanic market in that, you know, they're sort of anti-bank. You know, just the banking system in Mexico is really tough, you know, with inflation and, you know, devaluation of the peso and things like that. And so by their very nature, when they kind of come over there, they literally would rather have money, you know, under their mattress than in the bank. And so you're contending with that. Then you add to that the complexities of just owning a small business. I mean, if any of you guys have ever opened a small business, between, you know, filing your franchise taxes and your payroll taxes and your, you know, and all that. And then on top of that, the banking sector says, well, now I need, you know, monthly financial statements and quarterly this and that. And so it's just way too much. They're interested in keeping the doors open. That's their main objective. And just running the day-to-day business, everything else is secondary. So producing financial statements and having to walk into a bank with this stack of paper, it's just not going to happen. And so what we did is we said, how do we go and target those folks that are in that category but still have a viable business, and what are the data points that are going to tell us that these people, you know, are worthy borrowers outside of just a credit score? And so, you know, we partnered up with LendIt, for example, and we're looking at transaction data via their bank statements, and we put a credit box together depending on that, and we created a cash flow analysis just based on, you know, the last 6 months to a year's worth of financial statements. And what we found was intriguing because, you know, as we went and piloted this program and we started to roll out, you know, offers to folks, the very first person who applied, it's something out of a book, right? Because here's this lady she had lost her husband, she had gone through chemo, she had opened up a candy store. In the Mexican culture, we love to mix stuff. If any of you guys have ever been to Mexico City, you'll understand. You mix stuff together and you sell it as a product, like Doritos with cheese and all this stuff that is not good for you. And that's exactly what this lady was doing. Yeah, it really is amazing. This lady had done exactly that. She used sort of her culture back in Mexico, and she had opened up 3 locations, had zero clue about financial analysis, but she needed money for the next location. And so she was our very first one to apply. She applied, it was a $50,000 loan. And when we looked at the analytics, we said, there's absolutely a good borrower here, but there's no way we would have underwrote this in a traditional model. And to get that money out to her, it was a joy for us to be able to do it and say, wow, our very first one. And it really is the driving force to us to continue in, you know, this type of product. There are borrowers sort of in the weeds that need our product, and they need them now.
I think we followed a similar approach. So we operated in a 5-state region in the Southwest for a very long time. Then right before the pandemic, we started to expand our geography. Then the pandemic accelerated that expansion. We're currently in 28 states. So there's no need for me to clarify, but but obviously that expansion is digital. No? So that puts us in a tough spot in terms of, okay, we know we have the technology, we have the partnerships, we can do this, but how do you stay true to the mission, and how do you actually find ways to give certain entrepreneurs or small businesses the time and the effort and the dedication to get them through a process similar to what Joe mentioned, no? Where they basically have a loan officer sitting with the entrepreneur or the business owner or whatever, going through the full application process, pulling more information. You know, many underserved entrepreneurs don't know they can have a cosign or a collateral, or, hey, you know what, if you need $50,000, maybe you can start with 10, or maybe you can start with 5. So that piece is very hard to automate and maintain that level of interaction. So what we have, the process that we've been going through and continue to go through is to find ways where we can automate as much as we can, put as much third-party information on the entrepreneur as possible when the information is available, and build different paths for the entrepreneur. If an entrepreneur needs that 100% attention, we'll find that path for the entrepreneur. If the entrepreneur is totally comfortable going through an automated process and can be underwritten automatically, we have a path for that. And if it's an entrepreneur that's fully, cannot get any type of capital, we'll give that entrepreneur $200 or $500 to get them on that path. So I think those are the biggest challenges to really how to meet that type of entrepreneur where they are at and be able to serve them.
So I'm going to hit a topic, and when I mention this, I don't want to see, I'm hoping it doesn't cause any sort of nervous tics or anything like that, and that is the CFPB 1071 that many of us have been following on how that impacts small businesses. So I would love to just open it up to any of you, as you think about the 1071 rule and how is it going to impact your institution? What keeps you up at night, and how can fintechs help?
I'll get started. I was talking to my congressman that sits on financial services, and this was the very question that was posed last week in sitting down with him, and he's on one side of the aisle saying we need CFPB 1071, and I'm saying, well, not quite. And one of the reasons I was telling him is, people walk in for an auto loan, as an example, a cash out of their auto loan to go start their business, and so you start. Every small business loan is just so different than the other. They might walk in asking for one thing, they walk out with something else, and it doesn't fit in a box. And if HMDA is any history for us in the banking world, and you guys in the banking world know what HMDA is and how complex it is, and not only how complex, the margin of error is so small because if an examiner sees it just a little bit differently than what you had, then you've got yourself, an MRA out there. And that's just not the way we want CFPB to be looking at this. So there's so much fluidity to the small business world that we just don't think that tracking it is the best use of anybody's time, quite frankly. Having said that, it's upon us, it's going to be here, and if it's here, we're going to have to comply, and there's no better way to comply than the use of technology. And so we're just going to have to embrace it if all else fails.
Anyone else? Anything to add?
I clearly think technology is the solution. I mean, that's the only way we're going to be able to manage it. I think the challenge is even, it's so premature. Like, they don't even speak with the SBA, who has their own demographic requirements, and they conflict in certain areas. And so, I'm sitting here having to make the right decision. Well, who do I listen to? The CFPB, the SBA, I mean, all of that. And so there's a lot out there that I think still has to be, they'll figure it out, but it's going to take some time to do it. But to your point, the regulators, I mean, it's the personality of the individual that's looking at your books. And, they take a different interpretation of maybe how the broader market looks at it. And next thing you know, you've got a letter or something that you have to contend with. It's a challenge. I will say this, the mortgage industry's been through it. I mean, we'll get through it. Yeah. It's just going to be bumpy, is the way
We've been doing it for a long time post-closing, right? So we track demographic information and been doing it for forever. It's part of what we do. But doing it on the front end, obviously, in terms of the automation and the process, like everything, no? It's definitely just an additional requirement and a challenge.
Okay, let's open it up to the audience for any questions that you might have, if there are any. See if anyone's brave enough to ask a question. All right, right here up front. Aaron.
More directed, I guess, from all of you as well, like on the consumer side, how interested are banks in introducing investing opportunities for their consumer? And like, I know you also spoke about losing the lending sort of thing, like if there's an opportunity to get that back, is that of interest, or is it always more on the SBA business side?
No, I think, we have a, personally, I'll talk about Texas National Bank, at our, last year at our strategic meeting, we said, look, enough's enough. We're losing consumer lending to the credit unions down the street and other players, let's just say, and it's just, we've had enough of it. So we sort of re-engaged and doubled down and went out and looked for technology providers, because the way we're doing, consumer lending right now, there's a reason why we're out. It's not profitable, so we got to look at it in a different lens. So I think, from our perspective, I think the industry as a whole, we have to be able to take care of the client holistically, not just one product.
Great question. Right back here.
I'll let you finish. Just like investing services for
In-
banking clients in general.
Yeah, he's asking about considering investing services for the consumer through the bank
Create like a stickier experience, money staying.
to create a stickier experience.
Yeah, I'm happy to
Is
speak to that.
anyone-
I mean, from BayFirst's perspective, it's not a part of our product roadmap or our strategic plan per se. But certainly, I do think there's other banks out there that are seeing that there's a huge opportunity there to create that stickiness, to create that additional offering, to improve that experience. It's just not our expertise. Again, that's maybe where a fintech can step in. But as of right now, it's not in BayFirst's plans, but I could easily see it for others.
Well, bank our size, we have a fairly large insurance agency. We have an investment advisory group. We have all of those. I think one of the challenges for traditional banks is you end up with the silos of very good products, and the holistic approach of that client is a struggle. And it's how do you cross-sell, to use the term, those products and really do get a whole household relationship. Some are better at it than others. I think technology will definitely play a part of that. We're going to have to get better at understanding our own data in order to do some of that. So.
Okay, let's go back here.
We may take
Years. Yeah. Yeah, years. You've hit the nail on the head. So I spend a considerable amount of time managing up within the organization as much as I do externally, because you have career bankers. Their dad was a banker, or they were the CEO of a small bank that got acquired, and now they're an executive in the bank. And there's misnomers, there's misconceptions about what fintech is. I mean, we jokingly, I think I told one of you guys earlier that when, and I don't want to bring up a bad subject, but SVB scenario came up, somebody asked me, so what's our exposure to fintech? And I just kind of looked at them cross-eyed. I was like, fintech's not a NAICS code. I mean, it's not, it's right. And it's like, it's a solution. It's a series of solutions. But they're looking at me because they know what we're doing and these partnerships and the success we're having, and they think we have exposure to fintech. And I'm like, well, boy, that's you can imagine the amount of conversation it takes to unwind that type of thinking. And so I think it's going to be a challenge. I think some banks are going to be better at it than others. I think acquisitions will force some of it, because banks and efficiency ratios are key. And in order to get some of those efficient, we have 400 branches. So to the consumer side, I mean, we still have boots on the ground in most of our markets that drive a lot of the consumer stuff. But that's not scalable in the current world. Plus, you guys, as in fintech, are doing such a good job that a certain amount of this is going to outrun us if we don't innovate and we don't get on the train and understand where our role is in this broader market of technology. I don't think we have to be leading edge. I think we have to be sound, solid performers in that world, right? There's going to be somebody with the next greatest idea that's going to outrun us, at some level. But as long as we're good, solid performers with technology as a core piece, we'll be okay. But it's going to take some time, and a lot of banks are going to struggle.
So I think one of the things is, look, there's extremes on every side, right, in terms of culture. And so I think coming to the middle is the key. I can tell you from a traditional banking standpoint, when we look at a fintech and our cultures don't match, let's call it what it is, right? But if they more closely match with us than not, then that's probably a partner we want to choose. And so we will, sort of push out some fintech partners just because they're too extreme. And probably the same thing on the fintech side. They're going to push out some of us as bankers because we're too conservative. So somewhere in the middle is where we're going to be able to play together.
I think you also need to, you brought culture into the conversation. And like anything with culture, you need to do it from the inside. So you either hire for it or you find champions within the organization that are convinced that that's value add. And then there's the numbers, right? So for example, in our case, our average loan size is $20,000 on a term loan or a line of credit, $20,000. So that's the most expensive loan that you can make. So by bringing in technology, automation, partnerships, fintech, call it whatever you want to call it, you bring down the cost of processing an application, acquiring a client, servicing it significantly. And that, coupled with the change in the culture or the champion or however you manage that with time, in a very short amount of time, can convince anyone, right? Especially if there's additional volume, new markets, et cetera, et cetera.
I'll just take 30 seconds, Brock. I think that's a great question, right? And again, we all just are experiencing that. It's a grander picture of change management in a nutshell, right? It's like, how do we get people, A, to approve of potentially a new partnership or vendor, and then get them all on the same page. I mean, try explaining to your chief credit officer that we're going to start using AI for credit decisioning. To the folks that have been running banks historically for the last 100 years, I mean, that's mind-blowing.
And offensive.
And offensive, touche. But no, we've come from a culture that is, if it's not broke, don't fix it. And we all need to think differently. And I think we all pride ourselves being on stage because we're trying to think differently, trying to bring those new ideas. And a lot of great ideas come from within, but also from partnerships too.
And I love this group. The reason why they're here is because they are championing this within their organization. We don't want, people ask me about kind of working with banks and fintechs and all that. We don't want banks to be the most innovative, fastest moving organizations, and we want stability and control and compliance and regulatory and safety. Like, all of those are really good things. Fintechs have their, around innovation and around speed and around technology and development. And so it's like, how can you marry that? How can you take the best of both worlds to be able to create something that's really valuable? And I think that's what these gentlemen are championing within their organization.
I was going to add real quick, we threw a culture bomb into our organization, and it was called PPP lending. Right? And
Yes.
I say that, and I'll share, we were a $400 million bank at the time, and we said we're going to go all in on this because of some of the channels that we kind of knew, and it was going to be highly supported by SBA and the federal government. And so I came back to my team, and I'm like, we are going to do this, and we're going to do this in a very innovative way. And so $400 million bank, right? We lent about $430 million in PPP lending, 16,000 loans, which, for an organization that was doing maybe 50 loans a month, when we're doing 1,000 loans a day, I mean, so all of a sudden, it was the must-have of, okay, we got to re-engineer this. We can't do it the traditional way. How do we bring technology into this? And it has transformed my organization. We partnered up with LendIt on that, and I mean, it's been a game changer for us.
And I got a few calls, nervous calls at night sometimes. Joe called me in the middle of the night.
But I'll say this.
Are we going to get through this? Are you sure? I'm like,
But I will say
get through
this.
this together.
But it was because of that, the ability to call Brock and say, okay, Brock, this is the pain point, this is the issue, we're not thinking about this, this, and this. And the fintech world saying, we get you, we understand, let us help you address that concern is why we did well together.
Or adapt to, the needs of the bank, I think is
Absolutely.
critical from the fintech. Alan, what were you going to
All I was going to echo, PPP was, if anything good, if you will, came from that experience, that was one of them. It forced banks to have to innovate. And so all of a sudden they didn't look at me like I was cross-eyed any longer. They were like, oh, it worked. And so you're right. And so now the next conversation was that much easier. And like you, I mean, we did well over $1 billion with that, and we had almost no fraud. Now we kept it much closer to our vest on who we lent to, but we did partner with one of our partners to do that, and with a lot of success. And so it was it's one of those events that allowed us to take a leapfrog with technology.
And we're hearing that from every bank in the market that participated in a PPP. Like, previously, lending to someone online or lending to the smallest of small customers really wasn't a part of the lending program, but kind of PPP forced a different viewpoint of how they're thinking about underwriting. What were you going to say, Francisco?
I was just going to add that, I mean, if you even drill down more and kind of along the same path of your question, which was a great question, I do think also PPP allowed more traditional organizations, be it a bank, a CDFI, to actually believe that they can do that level of lending, that they can actually provide that level of access, that they can easily reorganize their processes, their teams, their technology, and really, really blow it out of the park. And I think just by putting that seed of belief in the organization is transformative.
Time to wrap up. Hopefully you can see why they are up here on this panel. They are true pioneers in the space, doing some really great things to innovate and help Main Street America, help small business owners across the country get access to capital. So if you wouldn't mind, join me in thanking them for a great panel. Thank you.